Welcome back to the Business Banter podcast, episode number 5. I'm Mark Plymale, joined as always with Spencer Johnson. And today we're going to be talking a little bit about investing and talking about individual stocks versus index funds versus mutual funds, kind of like what's better because there's so many different options. And we're going to talk about what is the best option. But also going to talk about some alternate investments such as options trading, cryptocurrency, collectibles, art, watches, things like that. Anything that you can buy and potentially sell later for higher value. Going in depth with that. Also, we're going to talk a little about how we're currently both investing. Then a little later on, we're going to get into some of the credit card news, like a little bit roundup from the week. There's been kind of a lot that's gone down, and we're just going to recap some of the larger stories. And then, as always, we will end with a question or two from our Diamond status members from the credit community Discord that Spencer and I co-own with Daniel Braun. And I think that's it. Should be a pretty good episode.
Yeah, definitely chock full of stuff. If people are here from our credit card type of content, I hope y'all enjoy the end of it. We're definitely going to be covering a good amount of stuff pretty quickly, so it's going to be fun.
Yeah, we'll touch up on all those topics and we're not going to go super in depth with those, but we'll at least bring those to your attention if you haven't heard of them.
Right.
But I'm interested to talk about the investing. I kind of used to be really into buying individual stocks, and I thought that it was really fun. I liked the idea of having like a bunch of Apple stock or like a bunch of Amex stock or JP Morgan, bigger names, Johnson and Johnson. But I have kind of shifted as I've gotten a little bit older. I've shifted that totally. And now I am way bigger into index funds or actually even just mutual funds. I think that's way easier to kind of be more passive about it. You don't have to think as much and research as much. You kind of just buy it every week or two and that's it. You just let it do its thing. I don't know. What do you think about that?
Yeah, it's interesting because I think everybody kind of drank the Kool-Aid of investing really in whatever stock you wanted back before the pandemic and everything
True.
Or during it, I guess, when everything was just, skyrocketing before the crash. And basically everybody was a genius, individual stock investor.
You couldn't pick it wrong. If you did, you were the worst investor ever.
Yeah. So that's kind of like when I felt like I really got into investing. That's when crypto was doing really well too. That's just when the buzz around investing was big. So I used to dabble with individuals and like more small cap stocks, not even like just buying Apple or Tesla or these big names. Like I'd try to go find the good deals on the small to mid cap stocks. And I mean, I guess I still hold on to those, but I've definitely also shifted mainly for the same fact that you just mentioned of I just wanted more simplicity in my life. And, while I was in school, I guess is maybe like that distinction between when I switched from individuals to like more index fund investing, because I had time while I was in school to research. But once I got out of school and I was making real money and, had to open up a 401k and do all this stuff, I figured, well, I might as well just throw it into like the S&P 500 and not really think about it, just let it grow. So that's kind of how my mindset has changed on it. But I've got some fun experiences with other types of investing too.
Do you have, so you said you're still holding some of those small caps that you bought back in like 2021 or whatever. What are those?
Oh my God.
Do you know the names of them? Because I even during that time, I stayed away from the smaller ones. I was buying options on some of the bigger names like Disney, stuff like that. But I never got into buying like GameStop and stocks like that. I just thought personally it was really stupid. Like I think that there's just no value in companies like that. I know a lot of people made a lot of money, but I have a hard time buying a stock like that's not a big, huge company that's already just proven so much success over such a long time.
Yeah, that's fair. I mean, the ones that I invested in honestly were mainly in part, I was watching a ton of videos from the big personal finance circle of creators like Graham Stephan, Andre Jick, Jeremy Lefebvre. I don't know if you've seen Jeremy's videos, but he was like the main one that I watched for investing.
See the financial education?
Yeah, financial education, Jeremy. Yeah. So that's like me and my buddy were like really big into him and trying to just learn how to invest from him, which I think was still super valuable. but
Absolutely.
a lot of what we did ended up just being basically copying whatever he was talking about.
Yeah.
So there weren't good
That's crazy.
investments in there, but I mean, now I was messing with small amounts of money then, so I
Sure.
haven't sold most of it, and it was in my Roth, and it's just
Yeah.
in the dumps. But now it's kind of fun to look back at the the good times of thinking I knew what I was doing.
It's cool that that's still sitting there. I noticed when I was buying individual stocks, I have a tough time holding on to them. I
Mhm.
get right when I see some green, if I'm up like 10%, I am very tempted to sell it and move it to something else.
Yeah,
Like I
fair.
always was. I was very much like always on my phone looking at it and like, oh my God, I'm up like $200 today. Like I want to take that. I'm gonna sell it, sit on it today, and then tomorrow I'll buy something else. And like I was
Mhm.
even though that is not the way to do it because I'm paying so much more in taxes on those gains. And also I just was kind of obsessed, like always
Yeah.
looking at my phone, and I hated that. It's like I
Yep.
don't want that to be. I'm not a trader. Like I'm not good. I'm just buying stocks, and everything was going green anyways.
All right.
So I've totally shifted out of that, and I actually don't even like ETFs as much as I like a true like mutual fund that trades intraday as opposed to interday. Like
Hmm.
once the trading day closes at 4 p.m., everything settles down, and then those like I guess the purchases are made, and
Right.
that's when the value of your mutual fund changes. I like that a lot more because during the day, I don't have to look at it because
Right.
nothing's happening anyways. I have no clue what's going on. At the end of the
Yeah.
day, I'll know if like I made money that day or lost money that day. Much healthier way for me at least to look at it.
Yeah. It's funny you say that. That was a big reason besides like the time investment I was talking about, or I guess underlying that.
Mhm.
A reason I switched to index funds was because I was so hyper focused on every day's gains and losses when in reality it
Yeah.
just didn't matter. Like, I mean,
Yep.
we're talking like hundreds of dollars that I'm investing, or like maybe
Yeah.
a couple thousand, you know.
Yeah.
I guess the most I had like in at one time, I guess would have been when I maxed out my Roth the first year I had it, which was 6 grand.
Mhm.
But I think by the time I even did that, I was already like mostly in index funds by the end of that year. But for a few months, I was really checking it on the daily basis and had nothing better to do. And
Right. Well,
it can
it's
pay off.
addictive. It's
Yeah.
absolutely addictive. I think of it just like gambling, and I don't gamble at all. But I think it's the same thing. Like even a buying an individual stock, but if you are consistently looking at your phone, trying to consider selling it and buying something else, I mean, it's basically just like gambling.
Right.
And also options trading, which I want to talk about that a little bit too. I started doing that in 2021 and I had some success, but again, it's one of those things you can get obsessed with and you're always looking at these numbers and this data. And in reality, if you just bought index funds or mutual funds, S&P 500 stuff and just set on it, you'd probably do better. Like, right?
Right.
Isn't that like 8% per year? Most traders aren't going to beat that. They're really
Right.
just not.
Yeah. It's it's super interesting. I guess the addiction side, I can definitely see like how that relates to gambling. I feel like the options trading is much more gambling than normal, just even individual stock investing.
Hmm.
I think, like I said, too, talking about the research I did on like Jeremy's stuff or just in general, it does teach you how to at least value a business if you go at it with the intent of learning skills like that. But
Right.
a lot of times, especially back then, like we are talking about, like you could just invest in anything and think that you're really smart and learning stuff. But so I do think I took away some valuable skills, and I technically paid for a course on that, if you will, because I
Hmm.
lost money in my trades. But um,
You did. You paid for that.
yeah, I could have used paper money. That would have been better, or paper trading.
Yeah.
But I think
I've never done that.
I was going to say before we get too deep, we probably should explain what the difference is between all of them, just in case people
Absolutely.
don't know.
Yeah.
Uh,
Yeah.
if you want to start,
Individual stock. Yeah. So an individual stock, just straight up the stock of a one single company. Think of any company that's public, JP Morgan Chase, American Express, Disney, Pfizer, Johnson and Johnson, all those companies, you can buy this individual stock for that company. And you basically are a, very, very, very small owner of that company. Um, you can buy them and sell it whenever you would like. And then like an ETF it's an exchange traded fund. It's basically a conglomerate, just a big bundle of a certain group of stocks. There's like sector ETFs, like healthcare stocks. Those are all the biggest healthcare companies bundled into an ETF. And it trades the same way. You can buy a share, sell a share, but it's just a bundle of stocks. There's also index funds, kind of the same thing as like an ETF, but they track, instead of like a sector, they would track like the entire S&P 500, things like that. And then also mutual funds, it's very similar, but there's more costs associated, and mutual funds do have like fund managers and some fees can add up in a way, whereas index funds are typically very, very, very low cost because there's
Right.
no true active managers. There's no one on the back end doing buying and selling of stocks on those. It's just that those are the stocks, and those are what are in there.
Right. Yeah.
If you can add anything that I missed,
Yeah,
you have
that's
anything you
basically
want to
how
add?
I would describe them all. I think the ETFs, index, and mutual funds are all uh, basically just baskets of stocks, is what I call them.
Mm-hmm.
They're weighted by percentage based on, depending on what index you're tracking. I guess they're weighted based on the percentage, like either size of the company or they're managed in that way. So like an index fund is passively managed, either by algorithms, I imagine, or it's not actively managed, which that's like the gap
Right.
between an index and a mutual fund. A mutual fund has an actual active manager, whether that's a company or whoever. That's why they're able to charge higher fees, while index
Mm-hmm.
funds are more algorithm based, and they do change their percentage, their allocations to each stock change over time.
Mm-hmm.
Like the S&P 500, as stocks grow or start to die down. But yeah, the baskets of stocks, as we were talking about earlier, are super just passive investments, because you can have like more faith that your portfolio is diversified by buying one singular stock in a way.
Yep.
So that's why it's like whenever people ask me how they should invest, I usually tell them it's basically just buy the S&P 500, because you're investing into the 500 biggest companies in the US. And like I said before, as companies drop out of that, they'll drop out of the S&P 500 and a new one will come in. If they continue to rise, you'll get more of a percentage allocated towards those bigger companies, and you don't have to worry about any of it. Like it just kind of
Right.
happens. But,
Yeah. Investing in an index fund is the absolute easiest way to get started. If you're
yeah.
young and you've never bought any stocks before and you just open up a brokerage with Charles Schwab, buying a ETF like VOO, something like
Mhm.
that, or SPY, that is such an easy way to begin investing and kind of like dipping your feet into that.
Yeah. Yep. That's exactly what I tell people to do. And then obviously there are so many different index and mutual funds and ETFs even that you can buy, to where it almost feels like you're buying individual stocks. But most of the
Right.
time you can just go in to see what they're actually allocated, what your money's going towards, and they'll show you the percentage breakdown, and you can see, kind of decide from there. If one of them has, more Apple in it than another one, I guess, you like them, you could
Yeah.
pick that one instead. But they're all basically the same, depending on if they're in the same category of
Right.
index funds or whatever. But
Big thing that you want to look for is the expense ratio, because that once you like one, if you're only investing like $1,000 or $2,000, even the expense ratio is a little higher, like 1%. It's not
right,
that much money that you wouldn't notice it. But once your investments do get up to, if you have $100,000 or $200,000 and you are investing in kind of higher cost funds, you actually will be paying more than you think, and those fees compound over time. It's the
right,
compounding cost kind of theory. um so you definitely want to be careful on what you're investing in and make sure that you're not paying a ton in fees, because with an
yeah,
individual stock there's no fees at all, right? That's
yeah,
why that is kind of attractive. If you buy Apple stock just straight up, there's no fees attached with that. There's no one managing that. It's just the company. It's just the stock. So you could buy 10 or 20 different individual stocks and kind of have your own little personal ETF that you built up over the individual stocks, and you're paying no fees. But that's requires a lot of extra legwork. And
yeah,
instead, you could just buy an ETF, pay a tiny bit in fees, and you do less work.
yeah. And to be fair, there even are like no fee index funds. Like that's actually what
True.
my portfolio is mainly made up of because
Fidelity.
yeah,
You use
because I
Fidelity.
do
Yeah.
mine through Fidelity. So
Yeah.
I'm young enough to where I'm like, okay, they're not. I guess the way that I've seen at least the Fidelity no fee index funds explained is that they're not actually necessarily tracking like the S&P because they have to be like they have to have fees associated with it to like exactly
Right.
track. But so what that allows them to do is add a stock in though like Tesla because Tesla, for the longest time, I don't even know if it is right now, but was not in the S&P 500 because it didn't meet all
Right.
the qualifications. But
What is
this
Tesla
this
doing?
index fund could keep it like I think it's like FizRox or whatever they call it, like
Yeah.
FCROX. Like that could hold Tesla in it. So I was like, well, it's a little more aggressive, but I don't pay any fees and I'm young, so I'll take the more aggression. But so there's a
Tesla's
lot of ways
actually,
to play it.
I guess Tesla's they're not doing too bad. Year over year, they had barely budged, but back in January, man, they were down to $108 a share, but now it's back up to 280. So
Okay.
it's doing
Yeah.
fine. That's why, I mean, because with those stocks like that, those big ones like the Apples, and those are like the big market movers in a way.
Right.
Every index fund out there is so heavily weighted in those like top 5 stocks.
Right.
So when those top 5 stocks tank, you would see like if your 401k is, in a fund like that, it just drops so much. But right when those stocks start coming back, it's like a very, very suddenly rapid rise too. Those ETFs
Yeah.
are very heavily weighted with those biggest companies.
Right.
It's like the top 10 always makes up like 30 or 40% of the entire fund, and then everything else is like a tiny little slice.
Yeah. Yeah. I think also for most people, at least I'll set my expectation or like what I do with my money. I'll just put it out there because what we're talking about here, like when you're investing in individual stocks and stuff like that, is likely going to be in just like a normal brokerage account.
Mhm.
But whenever you have like a 401k, at least what I've seen most people's experiences, you're kind of given a list of mutual or index funds that you can buy into that your company's like broker or whatever for your 401k allows you to pick from. I don't know if your experience is like this, Mark, but
Yep. Yep.
that's
There's
how I
like
think
10
most
different
are.
ones I could pick from.
Right. So in that case, I think fees become a lot more important in a way because if you do have the option between picking a high fee or like mutual fund versus an index fund, like that's like the only control you really have in those
Right.
situations. Um, and I think that first of all that you should be investing in those tax or retirement accounts before investing in an individual brokerage. I mean, unless you're like
Absolutely.
trading, but
Yeah.
I wouldn't recommend doing that if you're just like a casual investor.
Always, my opinion, best way to do start off with a 401k. If your company offers it, go ahead and get the full employer match, then Roth if you want
Mm-hmm.
to do that. I've talked about that in the past. Roth a little bit overrated, but if you want to do that,
Yeah.
go with the Roth because it's a great account. 6K, 6,500, not a ton. And then any money after that, if you have more money you want to invest, go ahead and put it in a general brokerage.
Yeah.
There's your way to do that.
Yeah. Yeah. That's kind of what I say too. So I think I usually say after your Roth, go back. If you have extra percentage left over, you could go back to your 401k. Like you need to set a
Hmm.
percentage in mind before of your income that you're investing. And if
Hmm.
for whatever reason the Roth and the employer match doesn't add up to that, then you could go back to your 401k.
Yeah.
That's how I say to do it, just because again, majority of people don't probably even need a normal brokerage account because most people shouldn't be
They're not
trading.
doing enough. Yeah.
Right.
Yeah.
So, but yeah, I agree with that sentiment. And then I guess going back to our previous episodes too, this is maybe under the assumption that you've paid off debt and you've
Yep.
invested in yourself. If you're wanting to grow a business, like whatever you're doing with your money, you need to have a full plan. But when it comes to investment accounts, like we're talking about here today, that's the
Yeah.
order that I'd recommend too.
I agree.
I do have a couple of stories I was going to mention on this topic. You brought up Tesla, which is
Hmm.
one that I know a lot of people my age, especially, like really love. And I have a buddy of mine who, like, basically all of his investment was in it are in Tesla, like all of it. Like
100%.
not 100%, but like he was one of the
A
guys that I was
lot.
doing like these small cap trades with. He believes in Tesla so much that he invests like 75% of his investment accounts in Tesla.
Oh,
Which to me, I could never do that. I was so stressed for
me
him.
neither.
During 2021 or whatever, though, he was killing it. He was doing great.
You can. Yeah, if you pick the right stock, you're doing way better than just a general ETF. I mean, you definitely would. But if you pick wrong and Tesla doesn't perform well, then all of a sudden, there's some serious consequences that can come from that. That's crazy. 75% in one stock. I would never do that.
Yeah, it was something crazy like that. I remember him saying at one time he had like 40 grand or something in it, which for us is that's a lot of money at 21 whenever we were.
That's a lot. That's a lot to have in one stock. If you're comparing it to your net worth, if you're not worth $1 million, that's a good percentage of your money.
I mean, that basically was his, our net worth at that time. So, but yeah, so that was just an interesting thing. It goes to show that also, since we are younger, like, sure, like you have time to make up that money if you want to, but if you have to really, really, really believe in a stock to do that. Because, he's probably still holding all of that because he's such a fan of them that it doesn't matter to him whenever they do drop. You just have to be, or have faith in the fact that they'll be growing in, 20 years from now. And I have a hard time believing in a company that much right now. But
one thing that whenever I would buy individual stocks, I always wanted to buy a stock that paid a dividend. I liked that because I know, like, if a company's not paying dividends, then they can take the money that they would and reinvest it in the company and potentially grow it and make you more money. But I like the idea of a dividend payout. I like the idea of getting something consistently back from your investment. So I would never buy a stock that didn't pay a dividend. I'm not saying that that's the best way to do it, but just personally, I thoroughly enjoyed the idea of getting a payment. So, like, I never bought any stocks that didn't offer that.
That's super interesting. I wonder if that goes back to your whole philosophy too of like investing in basically blue chip stocks that are like super established and or investing in a index fund that mainly invests in those massive companies because that they've basically proven their worth. And dividend stocks generally, unless you're investing in the small cap dividend stocks that are paying like 60% dividends, you're
that's a dividend trap because those are going down faster. And once the dividend if the stock's dropping and the dividend payout is rising rapidly, that's a trap. Get out of there. That stock is not performing well enough. Yeah, I liked stocks that would pay a dividend anywhere from like 1% to 4%. Loved it. That's like such a nice way because if you have if your average dividend payout is 3% and you've got like, I guess for $1 million would be $30,000 a year. So if you had like 4 million in dividend stocks, 120K payout a year just from your dividends. That's amazing. Like that's hard to do, but that's like the true, like that's what a lot of the dividend investors do. Do you ever watch the channel Dividend Data? You ever seen that?
I definitely have seen it. Whenever I was back, really heavily investing, that's like that because Andre Jick's kind of the one that first coined dividend investing for me.
He was so into that.
Or he was a big dividend investor.
Yeah.
But what were you saying about their stuff?
Their channel's great. Yeah, I was watching that. I was like, I do love the idea of like the compounding growth of a dividend stock. But again, it was a lot of work. It's like I got to keep up with what these companies are doing. Like every time you buy an individual stock, if you have significant amounts of money in that stock, you still want to keep an eye on what they're doing. Like even with Apple, like Apple goes through time. Apple's having an amazing year, but they don't always. And if you're relying on a dividend payout and your company's stock is tanking, your payments will go down. So it's just more work. And I guess I'm kind of lazy. I think that I'm not, but I think I am in the same way. Like I'm lazy when it comes to stuff like that. And I want everything to be as easy and as seamless as possible. So that stuff, too much work.
Yeah, it's just priorities at the end of the day. Like when you're spending way more of your time investing in like your business than you are investing in somebody else's, I guess. That's kind of, that's how I am too. I know like my girlfriend's dad, he's like a really big investor now. He's like, I guess basically he's retired at this point. So that's like really what he does. He actually also invests in cars and he flips cars, which is kind of cool. I could talk about that for a long time, but he like only buys Toyotas also. So like the Land Cruisers and like, forerunners and all that. So
Yeah,
kind of
that's
cool. But yeah,
awesome.
he spends a lot of time managing his retirement accounts. And I know he likes the dividend stocks because that gives him a consistent monthly income, basically.
It's the coolest thing ever. I remember Chad Money's Minutes. I'll give him a shout out. He made a video on he like figured out uh stocks that paid out dividends weekly,
Hmm.
and I can't remember exactly, I guess, how many stocks that it was, but every single one of them, you got a dividend payment every single week. It was
Hmm.
like, so he built out a portfolio where every single like Friday he was getting a check. It's like, that's
That's kind
so
of cool.
cool. Like, you
Yeah.
are consistently, because that can be like a little side portfolio. You put like 20, 25 grand in that, but like you're consistently getting a payment from that. That's so
Yeah.
sick. I like that.
Yeah. Yeah. I think to caveat, this just came to mind too. We're mainly talking about people here that have a lot of money already
Yeah.
invested. But if you're hearing that, I don't know, this might be controversial, but in my opinion, I don't think that dividends necessarily matter until you have a high balance.
I agree.
Because if your first thought is I'm going to get into investing for dividends only, like you're going to be making, pennies a year basically if you have
Right.
a small balance. But once
You
you're
got to play the long
established,
game.
right,
Yeah.
right, that's everything with investing. You have to.
Mhm.
I mean,
If you're
yeah,
looking for that payout, if you're looking for just general growth, then dividends actually are probably arguably the worst way. Like, if you're
correct.
trying to
Yeah,
grow your portfolio as rapidly as you can, obviously contributing, putting a lot of your earned income in makes sense. But then you want to be a little bit more aggressive with your investments, and dividend investing is not aggressive by any
yeah,
stretch.
right.
So,
And technically, that's the same thing can be said for index funds because they're less aggressive than individual
right.
stocks. But again, it's a risk versus reward. You can also invest in extremely aggressive index funds and get similar outputs that you would from an individual while still
Yeah.
being diversified. So
There's like the Kathy Wood ARK,
oh god, yeah,
ARKK. Let me see what that one's doing. I used to have a little bit of that.
it was. I know.
45 $48. That's not bad.
I don't know what it was before.
2 years ago, it was 125.
Yeah, she.
It peaked out in 2021 at 150. It's on the rise a little bit. Year to
Hopefully,
date, there it's up from $30 to 48. That's pretty good.
it's not
But the
bad.
entire market's moved up fantastically. So I don't think that's outpacing the S&P.
Yeah, yeah.
So
There's
I'm doing better than that. So
yeah. That's it. Just goes to show. I mean, you could go watch like Graham Stephan's made plenty of
yeah,
videos about the like different ways to invest and what makes you the most money. And if you look at a 40, 50-year time horizon, you're making way more money just investing in the S&P or whatever
yeah,
index you want to. And
yeah,
as long as it's diversified in a way that's good, then you should be set for life by just doing that.
yeah.
Isn't that like the I don't know if it's the Warren Buffett portfolio or somebody? It's probably not Warren's, but there's some portfolio out there that is basically just 100% S&P. Like that's what they like live and die by. It's some famous investor, but I can't
I don't
remember who
know.
it is.
I
It's
think
like
it's fine though.
90 or 100% or something in S&P, and that's all you do, and you're good.
It
Makes it
really
work.
is. I mean, I don't know personally what else you would really need to invest in. Like, I like SWTSX. That's Schwab's total stock market mutual fund.
Mm,
I love that one for my Roth. Because it's got like every single stock in the entire US market. I think it's like 3,600. But
yeah,
still, when you look at the actual weighting, it's still those top 15 to 20 stocks. That's where
yeah,
the vast majority of it is. And those other like 2,000 stocks you've never heard of, it's like the tiniest little percentages. So if I just
yeah,
moved over to SWPPX, it would probably perform the exact same. I just kind of like the idea of it being exposed to every single stock.
yeah. I guess while we're talking about this, let's go ahead and move the uh, like topics around a little bit and maybe cover
Yeah,
what we're investing in right now,
for
just
sure.
because we're
For
already on
sure.
that topic.
Yeah.
So I guess you said total market for your Roth, but how are your
Yeah.
other assets allocated? I guess.
So talk about my 401k. So I've got that one with the tennis club that I'm employed at. And actually back during this past spring and winter, I changed my allocations because I was only making like 100 or $200 a week from teaching tennis because I was doing
Hmm.
YouTube. And I just contacted the financial advisor there, or the 401k plan administrator, and said, can you just put my entire check into the 401k? He was like, no one's ever done that before, but let me see what I can do. So it ended up working out because with taxes it was 85% of it. And my net check would be like $2. So like I still had some taxes go out, and
Yeah.
then the vast majority go to 401k, and then I got paid like $2. But I did that all like for like 6 months. But then this summer, I was working a lot more and teaching or working a lot more there and making less YouTube content. So I was like, hey, can we drop that back to like 15? He was like, yeah. So now I'm doing like 15% of my income into that. And then they match like 5%. So it's like 20% of my income going to 401k. And that is all in, it's like with principal and the fund that I'm in, it's like 30 stocks. It's all blue chips. It's called like the blue chip account.
Okay.
It's like the top 30 stocks in the US. But then my Roth, 100% SWTSX. And then in my general brokerage account, I actually have a ton of cash. I'm sitting on a lot of cash right now, and I have a little bit in SPY. I'm sitting on a ton of cash because we're trying to buy a house. So I'm not investing as much and only keeping like about 10K in SPY, and then just sitting on a good amount of cash because we want to be able to put about $100,000 down on our next house. So
Gotcha.
that's kind of it. After that, I don't do any crypto, none at all. Don't trade any options right now, at least. Probably will once we buy the house. Go back into that a little bit because I think it's kind of fun.
Yeah.
I guess that's about it. Sitting on a lot of cash.
Nice.
Which isn't great, but I mean, we're
at least
buy a house. So
I wonder too, I don't know if the Charles Schwab brokerage gives you any interest on your uninvested money, but a lot of
it's like 1%. It's not a lot.
Okay.
I should probably move it over to a high yield. I don't care. It's not a ton of money. I'm like, I just rather leave it over there in the brokerage. It's not hurting. It's fine.
Yeah. That's I think that goes to show too what your priorities are with your investments. Like real estate is probably higher on your list. The other stuff's pretty passive.
Yes. So like right now, I want at least 3 houses. I'd love to get to up to 3 houses. And then I'd probably like right now, I don't care about stocks as much. But once I've got, real estate portfolio kind of built out, then I would definitely want to ramp that stuff up. And I do like the 401k continuing to contribute to that, and then the Roth as well. But with the general investing, like the general account, I don't care about it as much right now.
Yeah. Gotcha. It's pretty similar to what I have. I think so. Mine's a little bit different in the sense that I just had less time in the market.
Right.
So I opened my account probably in like 2020, or opened basically all my accounts. So I have a Roth. And I had like, I think I started with like Robinhood or something. I might have opened my Roth first, honestly. Like that was like going back to what we've talked about before of the advice that you hear on YouTube is to live and die by the Roth. So I think that was the first account I probably ever opened. But so I have that with Fidelity, and then I have, well, honestly, all of my accounts are with Fidelity now. So I had a 401k with my company that I started working with out of school. I only worked for them for about 6 months, and my 401k was only like part of that because you have to be there a certain amount of time to be eligible. So that was with their 401k provider. But once I quit to do YouTube full time, I basically just did a conversion to my Roth of my 401k because it had like a couple grand in it or something like that. So I only been investing. I was only investing at that time up into the employer match because I knew that I was going to be leaving. So I just wanted to at least get some money back. And I was basically cash stacking the last like year basically. But my investments in my Roth, which is again like my main only account that I have right now, I think it's like 45% in just like a no fee Fidelity S&P 500 index fund. And then I think I went a little bit more aggressive by, instead of just doing 100%, I did that 45%, and then I did like 35% in just like a small cap. I think it's 35. It might be less than that. But in a small cap, just more aggressive.
Sure.
Fun just to see what happens over the course of like coming out of the pandemic and stuff. And to be honest, I don't check it that much, but it seems to be going up, which is always good.
I think it's good to not check.
Yeah. for mental health purposes for sure.
Yeah.
And then I have like 10% in like an international small one just to have exposure, and then 10% in a real estate fund.
That's sweet. So
So
you got like
it's
that
all
a 3-fund portfolio plus your real estate.
basically. Yeah. I
Yeah.
mean, yeah, that's 10% of real estate, 10% international. So they're both very small weighted compared to like
Sure.
just basically it's a total market. I basically created my own total market index fund with large cap and small and just put them together for whatever reason.
I always look at the international stocks because that's like what Vanguard says, like the 3-fund portfolio. But every time I look at any of those funds, they just don't perform as well as any of the U.S. Funds do. So I'm like, I get the exposure because it could do well, but I'm always like, I don't know. I mean, I'll just go with what's performing better.
Right.
I don't know. I mean, again, it's exposure and it's a small percentage. So
yeah, exactly. That's the only reason I do it, just to say I have it. But to be fair, though, my investment strategy right now is basically non-existent since I've quit my job because, like I said, up until I quit for probably, I don't know how many, because I interned with them, so it's kind of all the timelines are thrown off. But let's say at least that 6 months that I did work for them, I was basically stacking cash. I didn't invest in my Roth. I haven't maxed out my Roth this year. I brought over that like $2,000 from my 401k to my Roth, but that doesn't actually contribute to my cap. So I still have like $6,500 I can invest, which I would do at the end of this year if I have the money. But yeah, now it's just been kind of cash stacking to see where my expenses and income line up with this new full-time job that I'm doing. So maybe a little bit contrarian to what we've been talking about, because I do obviously enjoy investing and have done a decent amount of it so far, but I'm investing in other things right now, really. So
that's important too. It's like I spend a lot of time investing in the business as well. I spend a lot of money on equipment and just time in general. And that's still an investment. Like I want to talk a little bit about alternate investments as well. As we talk about stocks all the time, but there are other places you can put your money that can get you better returns. And I think what you're doing, going hard with the business, that's going to pay you more than if you were just instead spending all your money and just buying into mutual funds or whatnot. This is going to give you better returns today, tomorrow, very short term gains.
Right. Yeah. And to be honest, I think the only way that even works though is if you like are reinvesting. Like I'm not investing in anything, if that makes sense. Like you can always just sit on cash, but if you're not putting it to work, then there's not too much of a point to it. But most of my business money goes back to the business to some degree. Obviously now I have to live off of it, so I have to take some, but
sure.
I try to have don't get me wrong too. YouTube is a very high margin business because I don't really have that many expenses. But I'm always trying to like innovate a little bit and add to my setup or do whatever to help make the videos better. Or go to conference or traveling to see people and stuff like that. All cost money. So there's just different ways to value investments, I guess.
Absolutely. If I weren't, trying to buy a house within the next year or so, I would put a lot more of that money into SPY. And what I really want to do is trade covered calls on that. That's a big thing that I want to do because it doesn't require a lot of work. It's one thing that you could do like 1 hour a week. You need 100 shares. Do you know what a covered call is?
Yeah, it's been a while. Probably should explain at least, mostly for other people.
So if you own 100 shares of an individual stock or an ETF, you can sell a call against it. So like if you wanted to buy a call option, I want to give a full options course, but if you wanted to buy a call option, you would be buying that option from someone who owns 100 shares of the stocks, because one call option or one option in general controls 100 shares of a stock. So I would like to have 100 shares or 200 shares of SPY, and just like every week or two or maybe month, depending on the payout, the premium, I would sell a covered call against my stocks. I would, sell it like if it SPY's at like 450, I would sell it at like 470. Someone out there thinks that SPY is going to go up to 470 within the next 2 or 3 weeks. I don't. So they would pay me a premium, and it would be probably like $200 or $300. And if 2 or 3 weeks goes by and the stock is below what they thought it was going to, I just keep the premium. The contract expires worthless, I get $300 extra in my account.
Right.
Then I would do it again and again and again and again. Now the
Yeah.
one you can't lose money doing that. The only way you could is if they were right. I sold the call, they bought it, and it did. It like closed like 475, and all of a sudden, I have to sell my stock at 470, even though it's worth 475. So
Yeah.
I would be selling it for a little bit less than it's worth. I would still make a profit, but I would be making less than I could have had if I just held and didn't do the option at all.
Right. Yeah. I think it's a really smart move because then again, the profit that you would have gotten. Well, let's just say that you bought those, the actual stock
Yeah.
years ago, or you've been accumulating for years. So your cost basis is a lot lower than what it actually is trading at today.
Right.
Even with that $5 loss, you're making a lot of money off of that trade because you're
You
selling 100.
always
Yeah.
you always go above your cost basis, right? You would
Right.
never set like if my cost basis is 450, I would
Yeah.
not sell a call at 440, right?
Yeah.
Because I'm like, if the stock is way down and I'm in a heavy loss, I'm in no position to start selling calls. Like I could, but it's so risky because like if I'm trying to make a little bit of money back in my premiums, it's just risky. Like you want to be doing it when you're in the green. So yeah, if your cost basis is like 370, you feel great. Like
Yeah.
you
You
don't
still
really
made.
want to sell those stocks because you will realize a lot of uh, capital gains and you're gonna
Right.
pay a lot of taxes in that. So really you want to be right. So
Yeah.
you set that strike price well above what you think it actually could get to.
Yeah.
But if you go too far away, your premium is going to be lower. So you need to put it at a spot that like could happen, but probably not.
Right. Yeah. And a
You
lot
end
of
up
those
making a couple
trading
hundred bucks.
yeah. And a lot of those trading platforms will tell you what the probability is. I don't know
Yeah,
how accurate it is, but
it's
yeah,
pretty accurate.
yeah. I mean, it's
So
statistics, I guess.
yeah, you'd go like I think you go like 25%, like
Yeah.
30% chance of that actually happening. That I'd be comfortable at that.
Yeah.
If you go
Then it'd
down to
be
like
good.
10%
Yeah.
chance of it actually happening, the premium is going to be like $50, and it's like I don't know.
You
That's
could
not
do
worth
it.
it.
Yeah.
Yeah, you could, but it's like I don't know. You want it to be actually worthwhile. But if you go to where
Right.
it's like 80% chance of it happening, your premium's going to be big. It might be like a $500-$600 premium, but uh, very high probability of your stocks being called away and you have to
Right.
sell. And then you're sitting on a lot of cash and you can buy back in. But if it continues to rise, you missed out on a lot of gains.
Right.
But I would
Yeah.
like to do that. I'd like three, be able to sell, like if I had 300 shares, sell like 3 of those contracts every 2 or 3 weeks. And I don't know, it's like kind
Yeah.
of like a side little thing. But I mean,
Right.
all at the end of the day, your money's invested in the S&P 500. So
Yeah. You're still
you're
making
pretty
money.
safe. You're still making money, still going up.
Hmm.
And it's just kind of a little bit of a fun thing to do on the side. I would do that with individual stocks too. Like I
Yeah.
would do that with like Apple. Like if I wasn't trying to buy a house, I would buy 100 shares of Apple stock and sell covered calls against it.
Yeah.
It's like the one thing that I would like to do.
Yeah. And options, which we've been talking about here, are definitely risky. Like that's what we were talking about earlier with like
Mhm.
they're definitely more associated with gambling. What you're talking about is not as much. I guess technically you're taking a 30% gamble if that's what you're
Yeah,
comfortable with. Of
you cannot lose money directly. Like you can still come
with a
out.
covered call.
Yes,
Yeah.
with a covered
Because
call.
I've lost money on options before.
Oh yeah. Just generally, if you're just buying calls or
Yeah.
buying calls or buying puts,
Puts. Yeah.
absolutely, you can lose 100% of your premiums. Everything you paid can just be virtually gone
Yeah.
because you're not
I
really
did that.
buying anything. You're buying nothing. You're buying the potential right to buy or sell at a later date. That's it.
Right.
At
Yeah.
a certain price.
Yeah. I remember my one experience with options. I bought some calls on one of those small cap stocks that I was talking about earlier that I still hold some just to
Mhm.
have. And yeah, I lost money. I lost everything. It just expired worthless. So I mean, it
Yep.
was like $600 or something. I think I put into it, which
Ugh.
for the time was a lot, but it was it's not too
I
much in the grand scheme of things.
I liked the idea of leaps. I was like, that's
Yeah,
pretty safe. That's pretty safe. I mean, come on. If you're buying, I can't remember what exactly it stands for, like long equity acquisition purchase, something like that. You're buying a call but you're buying it deep in the money and you're buying the expiration to be like a year and a half out.
Yeah.
So I did that for Disney at the beginning of, I guess, 2022. And oh my God, Disney did awful. They had like the worst year. They're doing so bad right now.
Yeah.
Um, oh God, they did so bad. I can't remember the prices and stuff like that, but I think my premium was probably like $1,500,
Yeah.
and it expired.
Yeah.
Totally worthless. So that's a $1,500 loss right there. I was like, okay, there are still, even if you're buying, I bought deep in the money and I even rolled it out. So I rebought again at a lower price to try to, like, I was like, it's called rolling
Yeah.
out. I was like, I think that Disney's going to go up eventually. So I ended up paying another 300 to try to like save it and like extend the expiration date. Still didn't work.
Yeah.
Still, I mean, Disney's just been on a horrible downtrend for like 2 straight years. They were at
Yeah.
almost $200 a share and they're at $88 a share. That's the risk of options, and that's the risk of individual stocks.
Uh-huh. Yeah, they're individual stocks on steroids. I mean, you're
Yeah.
controlling 100 of them, as we mentioned, is what an option
Mhm.
really is. What it comes down to, you're buying, or you buy or hold a contract for 100 stocks of
Mhm.
one stock. Um, but yeah, it's a whole nother beast that I think it's still super interesting. Like you're saying, like there are ways to make it
It
passive
is
even.
interesting. I think it's a very, very interesting. And like, if you time it right, I mean, if you're buying, like, if you bought a call on Apple, like, look at what Apple's done this year. If you had bought that same leap up on Disney, you bought it
Yeah.
in January, Apple was at 125. Today, they're at 190. So if you
Yeah.
bought a call on that, you are so deep in the money right now. I mean, you've probably made $10,000 just in that
Hmm.
one trade off of one option. If you bought 10 options, I mean, that's serious, serious gains. But
Yeah.
you got to time things right. And there's definitely luck that goes into it. You don't know what's going to happen in the market. You just have no idea.
Yeah.
So,
Yeah. The options I bought, to clarify too, were for like 3 weeks out or something, or a month out. So it was like,
short terms, that's
yeah,
typical. I mean, yeah.
it was hard to even make money from that, and it did not work. So
You're looking
uh,
for that quick bounce, the
yeah,
quick, like, if you buy it today, hopefully next week you can close it out, take your money and run.
that's
Because the
gambling.
closer it gets that, yeah, yeah, it's gambling. Closer it gets to that expiration date, it's just the value of those. It's called theta decay. It just drops so
Yeah.
rapidly. All of a sudden, it's like, if it's like $200, it'll drop to like $40 in like a day. It's like, oh my God.
Yeah.
Well, that money's gone.
Yeah, that's exactly what happened to me. And I was like, well, whatever. It's an experience. Another course I paid for with options
It
trading.
is. Yeah, those are losses that suck, but I mean, now you know, because a lot
Yeah.
of people have no idea what an option is and they might try it and I feel like now I've got some of the tools that I could be successful, but I'm staying away from that for a long time. And I don't think
Yeah.
I'd buy leaps again. I'd probably just rather buy the 100 shares of the stock. If I really like the company,
Right.
then I would just buy 100 shares of Apple stock and I would just trade
Yeah.
put for calls on it instead of worrying about the leap. The leap's cheaper, but if I had the capital, I would just buy the stock.
Right. Yeah. What is your opinion on like the other alternative investments like crypto? I guess we just stop at crypto real quick for a minute or two, so we don't go too
Yeah,
long.
I got into the crypto thing when it was super popular. Everything was going up, but I just don't see any valid use cases for it. I just don't see a world where it's necessary and an actual thing that's going to be worth real value. Like, what can you do with a Bitcoin right now aside from sell it for hopefully more than you bought it? Can you actually use it for anything that you can't just use a you know U.S. currency for? I
Right.
don't know. And so right now I don't even look at it. I have no clue what's going on in the crypto market. Nothing on my radar at all.
Yeah. I'm kind of the same way. I do like I imagine that at some point there definitely are use cases that can come from it, because I can't predict what will happen. Um, and all of the promises sound really cool when you talk to people. You can get like pretty down in the
Yeah.
trenches with it, and I that's how I used to be. I used to be like really like, oh, I can see the future of this. Not too bad. Like I wasn't one of the crypto bros, but I invested some of my money into it.
Yeah.
Uh,
Yeah, I definitely did too. I played with it. I think I actually made a little bit. I mean,
yeah,
I even bought some of those altcoins like AMP
right,
and like stupid things like that that were like, but the problem is they're always just pump and dumps. I know that they
yeah,
are. Like those smaller names, there's some big whale who's paying influencers to boost them, and then everyone buys it like the FTX thing, and then it just crashes because there's no actual value there. And then
Yeah.
the people on top, as long as they didn't like commit total fraud, they just walk away with a ton of money.
Yeah.
And then there's everyone else left holding the bag of some crappy, useless, fake internet coins. So,
Right. That's really
I
a
don't know.
lot of what they are right now. I mean, I hope that one day they become super purposeful and we use them. But at that point, it's also going to be so much more stable to where it's not going to be some crazy investment. It's just going to be
Yeah.
another thing that we have.
Yeah.
So it's just, I don't see the full vision of it, but I have invested in it and I'm pretty sure I lost all my money. Well, actually, that's not true. I didn't lose all of it, but I'm always just, I never really sell. That's my thing. I'm just like, which is why index funds work so well for me because I don't stress
Yeah.
about it, but I would just hold on to everything else anyways. So I'm still holding on to my crypto that I bought a while ago, and I bought it with Voyager, who's been going through bankruptcy for like
Oh, yeah. They even
6
open
months.
anymore? Yeah.
No, my money's
Can
just,
you even access it?
I can get to it, but I can't pull anything out.
Oh my God. That just
So
makes me sick.
the
I
interesting
mean, I
part
used
about it,
Voyager. I used them for a little while because they had like crazy APYs. That's like the
yeah,
9% on their stupid. That's how I hate that stuff. I
yeah,
don't like it.
that's it goes back to if it sounds too good to be true, then it is. That's like what all
Yeah.
of that crypto craze
Where's
was.
the 9% coming from? How are you? Because this is back when interest rates on bank accounts were like 1%. That was like
Right.
amazing for a high yield. Um, where are you getting 9% payouts for a crappy coin that has no value? Like how? Oh,
Yeah.
it's a Ponzi scheme. Like,
Yeah.
oh, 2 years later, they're bankrupt. That's
Yeah.
how these things go. So no, I right now, if I was gifted like $100,000, like, hey, you can do anything you want with it. It has to be an investment though. Cryptocurrency would be the last thing I would touch.
Yeah. 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 And speaking of those other things too, I know one big, at least one big thing that you see on YouTube a lot is like investing in designer things like watches is a
Yeah.
massive thing. And I do see value in that. Personally, I just don't even have, that's kind of like FU money, I think, to the point where you're investing in stuff
Yeah.
like that. Besides RJ, I think RJ actually invests in watches, RJ Financial, or at least
Does
has like
he?
one. I've heard
There's a
him
bunch of
mention it.
guys in our Discord. There's a bunch of guys in there who that I've seen their watch collections. It's like, dang, those I don't know anything about them, but
Yeah.
they talk about them, and I can tell they're expensive.
Right.
Dang, that's a significant amount of money to have in a watch.
Yeah. I think watches I can see the value in. Like I said, when it comes to maybe stuff like art, I mean, that's just like a whole nother level of.
I think art's a scam. I think art's a scam. I think it's a scam for like millionaires and billionaires.
Yeah.
Like there's
Some money
no
laundering or
like
something.
yeah, absolutely. You're paying off something else. Like there's
Yeah.
something going on in the back end. Like you can't convince me that a painting is worth $1 million. It's just not. Like
Yeah.
there's something going on where you are paying for something else and you're just pretending that it's for the art. It's totally laundering. Like there's
Yeah.
$1 million for a painting. What? Like
Yeah. Just buy the print.
how? How? I know the guy like if the guy's really popular and stuff like that, but come on. There's
Yeah.
something shady going on. I get like 20,000, 30,000. Okay, that's fine. But like $1 million for a piece of canvas with paint on it. I don't know.
Yeah, it's insane. I don't. Maybe we just don't understand yet, or something. Maybe once we're super wealthy, we'll really
If we
want
have
some
money
art,
that we need laundered, yeah, if like we're trying to do that, I'm sure we could get into the art market. I don't know.
Yeah.
I mean, I definitely think that's cool, but would that really maintain its value? Like, remember when NFTs were a big thing, like the
Right.
digital art? Um, I saw like Justin Bieber bought one for like $3 million, and now it's worth like $20. Like
Yeah.
that
That's
thing,
crazy.
I feel like it's the same thing, but like the NFT was just digital, like real artwork. If you bought a painting for $1 million, can you really sell it for more than that? Is it really gonna go up in
Yeah.
value? It's not the
I
Mona
guess.
Lisa.
Yeah. I guess that's the difference too of what I'm thinking with alternate investments of like watches. You can buy them for a decent price, and you can resell them pretty easily and pretty quickly. With
Right.
art, I think it's more for people that are just like, I have so much money that
Yeah.
if we're putting the idea of it being just money laundering aside, you're not going to care about getting a return when you have that
Right.
much money. So it's more just
I
like a
saw there's
status
that
thing.
one dude who was a billionaire, and he bought a painting. It was like $2 million, and he bought it with his Amex Black card
Yeah.
because he wanted the
Yeah.
points. It's
It's
like,
insane.
okay, that's crazy. I mean, $2 million on a painting on your Black card. Um,
Yeah. Pretty cool.
I I guess maybe one day I would get into the watch thing. Like I think having one really nice watch makes sense.
Hmm.
Um, but if I bought it, I don't think I'd want to sell it. I feel like I get like a sentimental value to something like that. Like if I bought a $10,000 watch, I don't think I would ever sell it unless someone offered me like $50,000 for it. Because I
Right.
feel like I bought that for myself, like as a, you know, I'm doing great in life or something like that, a present to myself. And I don't think I'd want to sell that.
Yeah.
I kind of get attached to like personal goods like that. Like that's mine. Like I worked
Yeah.
hard for it. I want that. I don't want to sell that.
That's
Or
fair.
like a stock or like something like that. I don't care. That's not real. It's like a piece
Yeah.
of paper. So like that's a lot different. Like personal items, I wouldn't want to sell personally.
Yeah. That makes sense to me. I think, yeah, the moral of the story with all the investments is like, I think if you do want to play with that kind of stuff with the alternate investments, it's like got to be very small percentage of your portfolio.
Hmm.
Like if you only have a watch and that's your only investment and you're not saving for retirement,
Yeah.
maybe reevaluate. Um,
Yeah.
so I don't know. Like that's why you do hear people like Graham Stephan. He always said like I won't put more than 5% of my money in crypto. 5%
Hmm.
of Graham Stephan's money is hundreds of thousands of dollars. That's
Right.
different. That's different than somebody like us who might have thought that, oh, I can put I can put 5,000 in this. It's no big deal.
Yeah.
But if that's more than you can really budget, then
Yeah, I
never.
guess I could. I mean, if I could put like $1,000 or $2,000 in Bitcoin and feel okay. Like, okay,
Right.
it's over there. What if it does pop off and go to $1 million, like the price of Bitcoin, and I end up making like 3 or 4x my money? Like that'd be sick. Um,
Right.
I would. I guess that's fine. Like a small percentage.
Yeah. I think that's why you can hear like when I talk about why I don't care, you can kind of tell that I don't care that I've lost the money that I have on
Yeah.
crypto and options is because I at least took that advice and I'm not putting money that I can't afford to lose into it.
Right. Well, you
So it
should
really
never be
is.
investing money that you can't afford to lose. Right.
Yeah.
That's
That
definitely
goes.
another
Yeah.
thing. Even with a safe investment like a mutual fund, they do go down. We have
Yeah.
horrible years in the market. And if that's money that you really need, um, and there's a downturn, I mean, we're in a semi bull market, I guess, right now. Who knows how long it's going to last? I don't know if there have been enough changes in the economy to really justify this. The inflation dropping to 4% year over year. That's still 12% over the past 2 years. I'm not sure why the stock market is going up as rapidly as it is. So I could see a downturn coming, a kind of a regression back to the mean in a way. So yeah, if you're investing money that you need, you're already playing the game wrong.
Yeah.
Because it needs to be money set aside that you are comfortable investing, and then you need your money over there on the side, like your emergency fund, just like your life,
Hmm.
running that, and then investing all on the side.
Yep. I completely agree with that. Probably maybe could have said that at the beginning. I just remembered to say that, but
Well, hopefully people are
hopefully,
still watching. We're an hour in and we haven't talked about anything credit wise. We actually talked way longer than I thought we would. I thought this was going to be like a 20-minute discussion on investing, and it's like an
yeah,
hour. That's
I know
crazy.
it always works out that way.
And
We need to
that's the
start.
beauty. This is business
Yeah,
banter. We're just going back and forth.
exactly. And I do think we've talked about before this too that we want to do some more credit focused episodes because I know it's
Hmm.
part of what our audience is, but we are
Yeah,
trying to broaden our reach here with this channel. That's
yeah,
a big part of it. So hopefully y'all enjoy all these conversations. But
yeah,
um, I guess do we want to go to like the little credit corner here? We can call it
yeah. We
whatever we
can.
want, but
Anything else you want to talk about, like real quick, or like summary on the investment? We kind of summarized it a little bit right there.
yeah,
Don't
I
invest
think
the
that
money that
was
you need. Um,
and
there's really no
just
wrong way to invest, I guess. Like even your friend with Tesla, I mean, if that's money that he can afford to lose and that's what he wants to put his money in, then so be it. He might end up outperforming everyone.
yeah.
Tesla is a pretty good company. I mean, they've done pretty well. They're more than profitable. So it's not like the same thing as putting in that money into a brand new company that has no profit yet. It's totally
Mhm.
different, but still risky, but not that bad.
Yeah, yeah. I think the summary of all of it is mainly just like if you want passive investments, index or mutual funds are a lot better way to go.
Yep.
Um, no matter what, you should be investing money that you can afford to lose in a sense. Like you don't need to be investing money that you need readily available. And a lot of times too, on that note, you should like a lot of these investments like we were talking about are probably in your 401k or your Roth, which you can't access anyways in a smart way until you're like 65
Right.
or whatever. So
Yeah.
it should not be money that you need to get out. So because you don't
Yeah.
want to pay a penalty. And then alternate investments, it should be like very, very small percentage of your portfolio. And really any investment you make, you need to be extremely passionate about it. Or it can be really
You
passive like S&P 500. I mean,
you
yeah,
do need to know what you're investing in,
yeah,
even if it is that ETF, whatnot. You should look through that. You should know the expense ratio almost off the top of your head, and you should know at least those top 10 stocks where the money's heavily weighted. I mean, just keeping up with that is very, very low effort, and you can just look at that information before you buy,
right.
and then at least you know what your money's in instead of just
Yep.
saying, "Oh, my money's in VOO." Like, okay, well, what's the expense ratio on that, and how, like, where is your money, like what stocks is your money actually in, and at least maybe track those 10 stocks every time
Yeah.
and time and see what they're doing.
Yeah, exactly. I think that wraps it up pretty good though. If we want to cover
Yep.
some credit related stuff.
Yeah. Yeah, we had a little list. Let's see. Okay, so there's a couple credit card creators on YouTube and made some videos about this potential new Amex application rule. Well, it's really more so like for a welcome offer.
Yeah.
Basically, to summarize, there have been some videos made where talking about that you can't use your tax payment to get a welcome offer, or to, like, if you're trying to get a welcome offer, you can't use taxes, like you can't pay your taxes.
Yeah, it won't count towards the
um
minimum spend requirement.
Correct, yeah, thank you.
Yeah. Yeah.
um and I don't, my take on it from what I've seen is that's not a real rule at all. um if you are applying for cards that are no lifetime language offers, you're already playing a risky game with American Express. And especially right now, American Express is not happy with everyone for some reason, and they are putting a lot of people in pop-up jail, and they're really cracking down on rewards abuse. And no lifetime language offers are ways, because Amex has that rule where you can only get a welcome offer on one of their cards technically in a lifetime, but that really means 7 years. But there's sometimes these like rogue no lifetime language offers, and it's kind of allowing you to bypass that and get another welcome offer on the same card that you already got within the past 7 years. So it's already risky.
Yeah. Where
And
do you even find those?
I guess Doctor of Credit, sometimes they're spread around on Reddit
Yeah.
and stuff like that. Maybe
That was
they're
honestly
spread
news
around.
to
And
me.
yeah, you've
I
never
didn't
heard of
even
those
know.
before?
No, I didn't know
Yeah.
it. I guess I maybe like heard that term. Like that sounds like a familiar
Yeah.
term, but I didn't realize that you could, I guess, get around the rule with those
It's
offers.
risky.
Yeah.
It's high risky. It's a lot of the time it is on business cards. It's going to be on like the business gold or the business platinum. And it's a risky thing. I personally would never apply for it with that,
Yeah.
because I've gotten the bonus on both the business platinum and gold before, and I've closed both of them. And if I were presented an offer for no lifetime language, I would not apply for it.
Yeah. Yeah.
I
Interesting.
value my relationship with Amex. I don't want to jeopardize that in any way.
Yeah. So yeah, I think I'm on the same page as you with it. Whenever like all the videos I've seen, I think Sebi's was really good on like just
Hmm.
covering it from like a like objective view, basically, like
Hmm.
taking in all the facts and like waiting a few days for it to kind of cool off. And I agreed with basically everything he said in that one. Like I think, as you just said, no lifetime languages or language offers in general, you got to be really careful with, and whether or not it just that rule applies to just those offers or it only applies to whenever you're about to be pushed over that welcome bonus spending requirement or what. Yeah, it doesn't really matter if you're just playing by the actual rules, but
Yep.
if you're really trying to get everything you can and you're one of those people that just don't value your relationship with lenders, then I mean, try it. And I guess you at least have that data point now. But yeah, I think for
Yeah.
the majority of people, it doesn't apply. It's you can still. Everybody in the comments of these videos are saying like, "Oh, I did this like a month ago and it worked fine on their offer," because it does still.
On
So
Sebi's video, one of his points is that in June, or maybe it was in May, Amex was advertising that you can use your new car to pay your taxes. Like they were advertising that in their language said that. So this is not a new rule. This is nothing that you need to think about. Like if you're trying to, like next year when tax time comes around next April and if you got to pay like $5,000 and you're thinking about getting an Amex card to do that, rest assured, as long as you're not using a no lifetime language offered, you're going to be fine. That's totally nothing wrong with that. Amex is more than happy to accept that payment and allow you to do that. And they'll give you points for that.
Yeah. Of course, keep an eye on the rules if they do change, if you're watching this later. But
that's as of today, July 16th, as of filming this, 2023.
Yep. Yeah, and I mean, I guess we could be proved wrong on this, but I don't think we will be. I mean, it's good to keep your eye on the market no matter what, but don't fall for the scary headlines. I think it's the kind of
I agree. Amex does have a lot of rules. That is not one of them.
Yeah, not yet. Hopefully never.
If I'm wrong, you can call me out.
Yeah, someone's gonna watch this in like a month, and
dude,
everything's
Mark
gonna change.
Is such an idiot. His takes are so bad.
Yeah, at least we'll get some controversial comments, I guess.
I get a lot of that. I'm fine with that. I can tell you.
But yeah, that is one thing that's been going on. It's good to keep your eye on in case you want to keep up with it. I wouldn't worry about it too much, but you can. I guess I can cover one of my topics real quick just to switch it up a little bit.
Yeah.
I know one big thing that happened pretty recently is Bank of America's basically being ordered to pay about $250 million for withholding credit card rewards and stuff, and just like a bunch of other stuff. They've just been pretty shady. They basically pulled a Wells Fargo, which just goes to show, I guess, that no bank is your friend. But I guess to be more specific, I'm reading the doctor.
Yeah, what exactly did they do?
Yeah. So they basically, what I can find is that they systematically double dipped on fees imposed on customers with insufficient funds in their account, which just is wrong.
That's so shady. That's so trashy.
I mean, they're already kicking them while they're down, I guess.
Yeah, exactly. Those are the poorest of the poor, the most downtrodden customers. Oh my God.
And then secondly, they withheld reward bonuses explicitly promised to credit card customers. That's very broad, but that's a big deal. I mean, you should
why we use their credit cards. That's the only reason why we use their credit cards. That's the reason why.
Yep. And then the last one, which arguably is the worst, is exactly what Wells Fargo's been in trouble for 10 years or whatever, which I think is kind of crazy at this point that people still care so much about that. But they misappropriated sensitive personal information to open accounts without customer knowledge or authorization. So that's the big, in my opinion, the worst one. But
they're all bad. They're all bad, and that's terrible.
Yeah, and $250 million for Bank of America. First of all, it's not that much money.
It's nothing. Yeah,
but I think it goes to show. Yeah, $250 million total. I was just gonna say, I think it goes to show again that you really shouldn't be extremely loyal to any banks because they're not there to be your friend. I mean, they are there to make money from you. We're there to make money from them. It's kind of like a mutually beneficial relationship if you play it right. But I know a lot of people that, swear that they will never, ever touch Wells Fargo again because of what they did. But I think every bank is doing stuff like this, and it sucks. It's a systematic issue, but we're playing a game here, at least in the credit card game. And I definitely feel bad for everybody that's fallen victim to this, and hopefully they get some kind of compensation. But
I'm like a big fan of Chase and American Express, but I've seen videos and they've done their fair share of this stuff too. Chase has done just as bad. But yeah, this is terrible. I mean, so one big thing when you are playing the credit card game, you really need to monitor. Like, I've got 16 credit cards. Well, I guess technically now 15. I have 15 credit cards. But I check them every day. I look at them every day and make sure that there's nothing weird going on. And I check my rewards balances and I check my credit daily just to make sure I know what's going on. And because I don't think that these banks care about me. They definitely don't. If all they want to do is make money from me. So yeah, make sure that you are tracking and monitoring your stuff. Whenever you get a new credit card, keep an eye on it. Make sure you've got the mobile app to where you can check it and just see what's going on with your balance and stuff. If there's anything weird, immediately contact customer service and get that resolved.
Yeah. 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 Sad story, but another good news topic to keep in mind.
Yeah. Yeah. Always check on that stuff. And yeah, these banks don't care about you. Bank of America is going to pay the fine, pretend nothing happened, and move right along. And honestly, probably continue to do it on a smaller end because it's
Yeah. And
profitable.
it's that's the thing too, is like, I feel like this is so, it's just going to be overblown within like a month. Like people won't even
Yeah.
remember it. But
They'll forget.
I mean, I guess I wasn't like physically involved with the Wells Fargo stuff, but, and I don't have any reason to defend them as a bank. But to me, it's just like, I hate that every single time I even mention them on my channel, people are like, "Oh, you never do business with that company." Like, I'm like, dude,
U.S.
they're
Bank
all
did the
doing
same
this.
thing.
Yeah, U.S. Bank. Yeah,
You could pull up an article on every single big bank. I think Wells Fargo, their thing was just they did it so often. It was
yeah,
a
yeah.
continuously recurring thing. Like if in 3 years from now, Bank of America is caught again doing the same thing, they would start to build up that reputation. I think Wells
Right.
Fargo did that. And I know they've cleaned house, and I don't care about Wells Fargo. Like I'm not that worried about that.
Yeah,
Um, I kind of used to be, but they've overhauled the top end and I guess clean
yeah,
things up. But I'm sure still down the road they'll probably do it again. Every bank
yeah.
will. It's too
Just
big
how
of
it
a
goes.
business. There's too much money to be made, and if there's not a hard set rule or regulation and people enforcing it, then the banks are gonna do what they can to make the most profit that they can.
Yep, and that's why me and Mark are going full in on crypto only. That's going to be where all of
Yep.
our money is sitting,
Yep.
because banks can't touch it.
Yep. I'm done. Done buying mutual funds. I'm going all in on altcoins only.
Yep, that's the way to do it,
Pump,
people.
and I'm gonna pay influencers to promote it and then dump it.
Yeah, that's the business banter coin
Yeah.
is coming out soon.
Yes. Yeah. Keep an eye out for the drop. It's coming out.
Oh man.
All right, another story. This is definitely still related, and actually something that I covered last year. Apparently, it's making its rounds again. It's the Credit Card Competition Act. Don't worry about this. If you watch Ben Hedges' video, I'm a big fan of Ben Hedges, and he's just reporting the news. But don't be worried about this. Um, Basically, the act would be to kind of allow for more open competition for credit card processing, which would make it more expensive for I guess the credit card rewards program for banks. And what eventually would be the fallout is credit cards rewards programs being, not totally gotten rid of, but they would not be as lucrative as they are today. Like you wouldn't be getting 5% back on cards, you'd be getting like 1% on everything.
Yeah.
Kind of back like the old days of credit cards. But this has been proposed multiple times, and it continues to be struck down again because banking is big business, and
Yeah.
senators and lobbyists are on the side of the banks. The president is on the side of the banks. Like they all make a lot of money from stuff like this. They Credit cards are banks like biggest industry. It's not
Yeah.
mortgages and investments. It's credit cards and it's people paying interest and stuff like that and processing fees. So this competition act would not pass, and the credit card industry is not going to change, in my
Yeah.
opinion. Again, I could be totally wrong, but that's my thoughts.
Yeah. I generally agree. I'm like, until I see more evidence of it, I'm not worried about it. Um, yeah, I mean, stuff like that again important to at least be knowledgeable about. But if you see yourself spending a lot of time worrying about stuff like that, first of all, you can't control it, so don't worry about it. And if it ever did happen, then we would adjust. I mean,
Yeah.
you can't do much about it. So
And what would really happen, I read an article, and again, I made this video last summer because it was making its rounds. And what would happen is they would actually just raise fees on other products. Like
yeah,
they would still keep the credit cards as they are because it's so profitable. The banks need that credit card, rewards programs, all that stuff. The banks make so much money off of people using those. So what would
Mhm.
happen instead of them nixing those rewards, they would just charge more for late payment fees. They would charge more interest. They would charge more for just bank account minimum balances, like if you don't have enough, stuff
Mhm.
like that. And so it would actually just end up hurting again the poor individuals, people who do carry balances on credit cards and who do have late payments and stuff like that. Those are the individuals who would be hurt by this the most, not people like us who are just like playing the credit card game for the points and rewards. So that's another reason why that's just not going to happen. And even if it did, it wouldn't have as much of effect as you might think.
Yeah. Yeah. I think it's just another thing to, like I said, to just know about, but don't stress.
No.
And if we eventually have to, whatever, we'll deal with it in a few years. But
yeah,
it's going to take a long time for anything to pass through government anyway. So don't worry about it yet.
We're all good.
But yeah, that's another news thing. And then the last news thing I had was about the Citi's changes to the AAdvantage executive card, the American Airlines card. Basically, they raised the annual fee to $595 from $450. And the biggest change that we were discussing earlier is that they've now added authorized user fees, basically. And eventually, or beforehand, they were free to add authorized users, as Mark, you told me. And that's super valuable in the sense that your authorized users got access to the Admirals Club, which I think is like one of the best rated like clubs that there are, or airport lounges. And for $450 on one card, that's not, you're getting in for pretty cheap compared to the actual cost. So that's
a big change, and it's definitely a big negative. I'm not sure, what are the other changes to the card? Are there like better multipliers or any other credits or anything like that?
Yeah, they've added some new credits. Also, the authorized user fee is $175 for the first 3 authorized users, and then $175 for each authorized user after that, which is like the platinum card. But yeah, it's a massive jump. Still could be very worth it if you're find value in it. But and I read too, I was telling you about, Mark, that I think they raised the actual price of the Admiral Club like membership or whatever. So it's like a logical raise in annual fee, but still sucks for cardholders that might not want the card anymore.
Right.
As for the new annual credits, they added up to $120 back on eligible Avis or budget car rentals. Another $120 back on Grubhub purchases. So $10 statement credit each month. Yeah.
Right.
And then $10 a month for Lyft credits as well after taking 3 eligible rides. That was the hitch. So everybody's like, that's kind of stupid. So you could make back $360 more. And they have some other bonuses and new earning rates. So it's still like a really good card, but it sucks that you have to pay more for it. Moral of the story.
Yeah. I hate annual fee increases, but they are inevitable. Definitely that, taking away the benefit of the free authorized users. That's the biggest downside. But I get it. Not on the side of the banks, but I mean, cards like that are wildly overpowered, eventually they come to their end. And it's like, I'm thinking that eventually will happen with the Hilton Honors Aspire card, right? It's so overpowered.
Soon,
eventually something's going to happen to it. But Sebi made a video talking about this in a way. He was like when a card, like, you don't regret getting a card like that if it does change. Like I've had the Aspire for years now and I love it. But if it were to change, oh well, that's fine. I'm glad that I got really good value from the card at the time.
All right.
And just, change is inevitable. Cards change and new cards are added and old cards are changed and maybe devalued, and that's fine. You use it. This is a tool. You use it all up, and then if you need to get rid of it, get rid of it and get a new one.
Yeah. And I guess if you are in that boat that you do want to maybe get rid of it, I always recommend looking at product changing first, just to keep that account active. Just product changing it to a no annual fee, or I don't know if they have a no annual fee American Airlines card, but
I wonder, do they do retention offers? Because you could probably ask for retention.
Yeah, you could ask for one of those too. I'm sure they do on a card that's that expensive.
Yeah, you could at least ask. Maybe they throw you like $200 statement credit or something like that, and at least cover you for the first year of paying the higher fee, and then.
Yeah, it's a really good time to do that. Every time there's an annual fee increase, asking for retention offers, you're much more likely to get one, I feel like, because you're like, I don't think I'm going to get the same value because the annual fee's raised, and like, oh, here, we'll cover the annual fee for a year or whatever. Maybe not for
and
this
they
card.
know that right when they raise the fee, they know there's going to be obviously negatives, and they definitely budget in that for losses for people. Marketing, like they'll pay more, they're going to offer big welcome offers, all that stuff. They fix those costs in. Whenever they do this. So they have the money they want to retain you. They don't want to lose you.
Yep.
So it's worth asking.
Yeah. But that was the main credit card news we have.
Yeah.
I know we also had a credit card related question from our Diamond status member. So I guess we might as well throw it in the credit corner here.
Yep. Yep. I can feel that it was when I started. It was Moses, the credit turtle. He changed his name. It's just been Moses, but now it's Moses the credit turtle.
Yeah.
He said, "What do you think is the best beginner business card?"
Mm-hmm.
So not just beginner card in general, but beginner business card. I would say, I guess the Blue Business Plus card. I think that's the easiest to get. The Amex Blue Business Plus or the Blue Business Cash, depending on if you'd prefer cash back over membership reward points. I think they're pretty easy to get. I mean, getting Amex cards is very easy in general. I think that Chase Ink cards are fantastic. I would say those, but I think those are a little bit harder to be approved for. So if you're talking about that true first beginner business card, got to go with the Blue Business Plus or Blue Business Cash, 2x on everything or 2% back on everything. No fee, such an easy card. I've had mine in my wallet for years. I think I've had it for like 3 years.
Yeah.
That's my pick.
Yeah, I think that's everybody's probably first answer. That's what I was going to say too.
Easy.
That's the first card I got, business card that I got. And I was like automatically approved as a sole proprietor for like, I think like a 10K limit, which is pretty common for most people. So it's a really good one to get started with. And then I went with the Chase Ink Cash after that. So yeah, I think the Chase Ink cards are the best business line of cards personally.
Yes. I think they're better than the Blue Business Plus.
Yeah. I honestly, I mean, it goes back to even the personal side. I always use the Chase Freedom Unlimited as a 1.5x card over any other 2% card, like even the Blue Business Plus, because I value Chase points so much. So it depends on what you want to do. But yeah, I think another thought process too that I had on this was maybe like, going for like some kind of co-branded card that's a business card also, because then you're not just beholden to like that lender's rules, but usually their co-branded partners want more customers, so they're more lenient on co-branded cards. It's like for me, I got the business Amex Amazon Business Prime card, which I think is pretty easy to get approved for. That was my first business card under my LLC, and I got approved for like a 12K limit like right away, which my income I was not reporting very high. This a few months ago, like right when I started going full time. Or like maybe the Amex, like the Hilton business card could be a good one.
Yeah,
right now,
the Marriott
especially.
business one, the Amex Marriott business, $125 fee, little steep, but I think you get automatic gold status. You get the free night. You get a lot of points with your welcome offer. If you're looking at like a card like that, co-branded, that's definitely it's a good keeper card. Makes a lot of sense. Pretty easy to approve for. Good multipliers if you like Marriott. Not a bad card to get.
Yep. Yeah, I mean, right now, I guess this will be coming out on the 17th. Yeah, we got a quick turnaround on this one, but
we've been cutting these last ones short.
No, the Hilton business card though, its offer is huge right now, and it ends in
it is
2 days, I think.
It
ends on the 19th
for sure.
So I'd look at that one.
Yeah, that Surpass bonus was tempting. I'm sitting at 324 and I'm holding off because I want the World of Hyatt, and I also want the Sapphire Preferred whenever the 80K comes back. So I'm holding off, but man, I'm tempted on something like that.
Yeah,
hate Chase 524 so much.
Yeah, I'm not even applying for more cards because I'm waiting. I think technically I'd come back under in September, so I'm not applying for any cards. I could apply for the Hilton business, but I decided to go for a retention offer on my Amex Gold instead, and just because Amex is weirding me out right now too. So I'm just like,
yeah, exactly. I don't even know if I'd like. I feel like I've been a great Amex customer, but you never know. You popped up for no reason right now. They're just being very stingy.
I don't know if you heard about this too, but they actually, this is what I heard from the credit community Discord, is that they pulled Blue Business Plus welcome offers.
Yeah, I saw that. That sucks.
And they also pulled referral bonuses because there's no welcome offers.
I haven't even had referrals on my personal Amex Gold all year long. They never gave me any, which is so weird. Yep. It's the
That's
weirdest
weird.
thing.
Yeah,
Again,
because
it's
I
like one of
think I maxed out all my Amex cards except for the new Prime card.
I'm maxed out my 2 BBPs. I've got 2 of them.
It's the
But
last time
I
you can do that, I
never
guess.
guess so. Sucks, man. That's and again, these things change. Like the credit card game, if you're playing it well right now, I mean, things do definitely change. You have to keep up with what's going on. Listening to podcasts like this can help.
Yeah, exactly. But yeah, it's another news thing. I heard that. I was like, that sucks because it's
Yeah,
such a
it does
good
suck.
card, and it's just
Yeah.
like easy to get value from. And it's 2x back. I mean, it just devalues the card to me so much if you don't get any bonus.
Any 2x card that doesn't offer a welcome offer, in my opinion, is not worth it.
Yeah,
Because
it's like the Citi double cash.
1x over 2x, it's not that much money. You're not spending $50,000 a year on your 2x card, probably not. And even if you were, that's only the difference of 50,000 points. Like if you just put it on a 1x card, it's like you need a welcome offer to really get value from your credit cards. Like
Yeah.
the welcome offer is so important.
Yeah, and that just also there are so many 2x cards with welcome offers. Like the built
Yeah.
card is one where I'd be like, okay, I'm fine with a no welcome bonus right now because it's so special
Well,
and
it's
like
so
a
unique.
unique.
It's so
Yeah,
unique. Yeah.
but a 2x card, you can find plenty of welcome offers. So that I don't know why they did that. It's just another weird thing that they're doing. But their stock, in my mind, is dropping, throwing it back to the investing. Like
Yeah.
could be a good time to.
Let me see what they're doing money wise.
I
'Cause
really
they've
like.
had
They're annoying me lately for some reason.
you noticed any drop off with their customer service? Have you noticed their customer service not being as quality as it used to be?
I mean, for me, I got my
Like chat
retention
team
offer
wise?
really easily, so I guess not. I haven't noticed, but I also
Yeah.
just don't talk to them much. So
I've noticed a little bit like their chat team, like I'll ask questions and they just have not been as helpful. Like, cause I'm asking, I guess not like very basic questions.
yeah,
And I guess it's not totally shocking that the regular customer service rep doesn't know that, but they just haven't been as helpful as they used to be. And sometimes they've even been like borderline rude. They're like, is that all I can help you with? I don't know. I just noticed a
yeah,
little bit of a decline in um, their customer service to me, at least to me, in probably the past 6 months.
yeah. Maybe something's happening deep in their systems.
A
I
lot
have
of
no
lot
idea.
of turnover, a lot of turnover. I would guess it's a tough job,
Yeah,
customer
yeah.
service in general for that, and people always sending chats and no,
It's
I
gonna
couldn't
be
do that.
tough.
It's a hard job. Yeah. I'm always nice to them. I would never be rude to one of those people. I mean, their job's hard and
Yeah,
I don't want to make it any harder on them. By being rude to them, but I don't know.
yeah, man. We covered quite a bit. We're
Yeah,
actually
that was a
recording
long
pretty
episode.
late too. For you, especially for
Yeah.
you, we're recording pretty late. I'm like,
Yeah, it's 10:20 here. I'm
yeah,
tired.
I'm
A
getting
long
drained
day.
already. But I guess as for our diamond status people, we forgot to even ask for more questions. That was a leftover question
Yeah.
from last week, but we're trying to. I don't know. Me and Mark will talk more about this, but we want to get more of a place where y'all can just leave those questions easier, like a new Discord channel or something where you can submit a form and just submit questions all the time, so we have them ready to go, so we don't have to forget to send a chat. But just expect more things to come for y'all, diamond status members, and we appreciate y'all leaving the questions you do.
Yep.
But yeah, I think that's about all I had to cover today.
It's all I had.
Awesome. You want to sign us off?
Yep. All right. If you have not already joined our Discord, link in description below. There's also some links down there to some of our other episodes. This is episode 5. Kind of crazy. Feel like we just started this, but we're kind of cruising our way through. Thank you all so much for watching all the way until the end. Really means a lot to us.
Yeah.
See you in episode 6.